Welcome to the Retirement DNA podcast. I'm Aaron Johnson. We believe you deserve financial advice based on your best interest. In our podcast, we discuss all aspects of retirement planning. And today we're going to talk about whether you should pay off your mortgage before retirement or not. So I came across an article that was written by an employee at Charles Schwab and figured I'd talk about this subject just a little bit because we get asked this all the time. So usually it's asked a couple of different ways. First, should I pay off my mortgage before I retire? Number two, do I need to pay off my mortgage before I retire? And lastly, should I put extra money toward paying off my mortgage or more for retirement? So I wanted to kind of start this discussion with two real life examples. So the first couple I'll call Bob and Cindy. They had about $130,000 left on their mortgage, but they had $200,000 sitting in the bank. It was just sitting in a savings account. It wasn't even put into CDs or anything. So they were wrestling with the idea of investing the money or paying off the mortgage. And this is something that's very common for people to kind of wonder. So their mortgage was at like 3.2%, and they knew over the long haul that they could make more in the market with a conservative investment, even after tax. So we had them come in. We reviewed their situation. They had a solid income. So even if the markets had tanked and crashed, they still had plenty of guaranteed income that they could pay the mortgage each month along with all of their other bills. So we did the math, ran the calculations, and we told them that mathematically it made sense for them to invest the money and to not pay off the mortgage. But they still seemed to just kind of struggle with the idea that they had this money and they're not paying off the mortgage. So while mathematically it didn't make sense for them to pay off the mortgage, but emotionally it made a lot of sense for them to pay it off. It gave them just such a peace of mind that it allowed them to kind of move forward into retirement with no worries and enjoy their retirement. So even though mathematically it makes sense for one decision, your comfort level, your peace of mind comes first. And for them, it was just getting rid of the mortgage, knowing that was paid off and that they didn't have to worry about that each month, even if the cash flow is strong. Now, if the cash flow is strong, it might make sense to invest the money. But what if your cash flow is more reliant on the markets and not on pensions and Social Securities and guaranteed income? It may make more sense for you to pay off the mortgage. You can't have a disruption to income in retirement that might stop you from paying the monthly mortgage. So this second couple that we'll call Tom and Stacy, they were still working. They were saving in their retirement accounts. Both had great jobs, and they were maxing out their 401ks each year. With a 401k, you can add in about $26,000 a year apiece. So they were each maxing those out, which is fantastic. They had about $110,000 left on their mortgage. It was going to be about 3 years or so until they were going to retire. They already had about $1.5 million sitting in their combined 401k accounts. So it's kind of a common situation where a couple has been saving into their 401k accounts and they're kind of slowly paying off their mortgage. And in this situation, we sat down with them and found out they really had enough already saved for retirement. And that money would be better used to go to pay off the mortgage. So they didn't have a big lump sum of cash that they could pay it off. But what we did was we dropped their 401k account contributions so that they were just getting the matches. Because remember, a match is free money and you can't pass up free money. So they got the match and then they directed the rest of what they had been contributing to the 401k to paying off the mortgage early. They were able to pay off the home in 3 years and later that year retired. And they did so with going into retirement and having that expense removed from their monthly expenses because they didn't have as strong a cash flow in retirement as the previous couple. They didn't have the pensions, so they were more reliant on their savings. So some of the pros and cons that this article kind of goes through, the first, for the pros, it eliminates that expense from your monthly commitments. And that's a big deal. If you can get rid of, $2,000 or $2,500 or $3,000 a month going into retirement, that frees up a lot of the cash flow. So that's automatically a big deduction in monthly expenses. The second pro is interest savings. If you had a mortgage rate of 3.5%, you now don't have to pay that interest on that money, right? And the biggest one, I think, in my book is the peace of mind. Now you don't have that hanging over your head during retirement. You can enjoy your time in retirement and not have to worry about paying this monthly mortgage on your home. You're just going to have your taxes and insurance and things like that. So some of the cons, you might have insufficient retirement savings if you're focused on paying off off the home and not saving for retirement. So now you may not have very much to live on. Retirement savings needs to take a priority. If you have insufficient cash, you've spent all of your money paying off this mortgage, and now that you don't have a savings or retirement assets, and now going into retirement, you're house rich and cash poor. Another con, for the third one, is you have higher interest debt. So maybe you've got a credit card debt that's at 20, 30%, or car loans or student loans that have a higher interest rate than your home. That type of debt needs to be paid off first. Always start with the highest interest rate and work your way down. The fourth one is opportunity cost. So if you have a low interest rate on your home, which a lot of people do now that they've refinanced, you could do a conservative investment and make more after tax on that investment than the home is costing you. So that's a possibility. But the other side to that is that if your mortgage is at 3.5%, that by paying it off, you're automatically getting a 3.5% return on your money. You're paying that off. So that rate of return. And then diversify investments. It is good to pay off the home, but you also need retirement savings. It's a balancing act, right? So if you concentrate on just paying off the home and then retire, congratulations, you don't have a home payment, but you also have no assets to live on. If you've saved a lot for retirement, that's great, but you still have a home payment, right? So make sure you know what your goals and your priorities are, and you can take care of both. Like I said, it's a balancing act. You can save more toward retirement, but maybe you make an extra payment a year to your mortgage to cut the time that you're going to be paying on it down. So just a quick story. Some clients of mine back in Virginia, their retirement plan was to buy a big home. They wanted to pay off the mortgage by the time the husband retired, and their goal was to keep this house with all this property and pass it on to their kids. They planned on living off of their Social Security and then the pension once he retired. So they concentrated on paying off the home and not saving for retirement. But the husband passed away very early. And when he passed away, the equity in the home was only about $300,000. His pension that she received was only a couple $100 a month at that point. So they had no savings. He had no life insurance. She didn't work, so she didn't have a job. And she really couldn't afford to keep the home. The $300,000 in equity in that home would not be enough for her to buy a smaller place and have the income that she needed during retirement. A reverse mortgage would only really get rid of the payment, but not give her an income that she would need to live on. So she ended up she ended up selling the home that they wanted to leave to the kids, and she lived in a small condo and lived off the equity and her husband's Social Security. and she's happy and she's having a great retirement. And I don't tell you that story to make it seem like she's destitute and living on the streets. She's enjoying her life. But had they planned and diversified their assets and where they were saving and paying off the home, she may have been able to keep that home in retirement. Remember, everyone is different. Everyone has goals, and there are different goals. And there's a lot of moving parts. So make sure you put a plan together to reach those goals. And again, everything is a balancing act. There are ways that we can pay down the mortgage and hopefully get that taken care of by your retirement, but you also need to make sure that you're building up those retirement savings. So our main goal with the Dwayne Johnson Group and Bridger Financial Services is to make sure our clients know that they can make it to and through retirement and can spend with confidence during those years. We want to make sure that they have financial security in any economy. Thank you for listening to the Retirement DNA podcast today. If you have any questions or would like to sit down with us for a consultation and to see if you're on track for your secure retirement, please give us a phone call at 951-244-6702. Again, that's 951-244-6702. If you like what you've heard, please subscribe to our podcast. Please tell your friends and family if you think that they would benefit from hearing the information. Also, you can check us out at thedwaynejohnsongroup.com or bridgerfinancialservices.com. Thank you, and have a great day.
Investment advisory services offered through Bridger Financial Services, LLC, a registered investment advisor in the state of California. Insurance products and services are offered through Dwayne Johnson Group, LLC, affiliated company. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Dwayne Johnson Group, LLC is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Dwayne Johnson Group, LLC.